Hello, I'm Carmen Trimarchi. Today we're going to talk about something that is dear to all of us, our money. In particular, we want to talk to you about ways of protecting it and ways of making it grow. We have with us today a man who deals with money every day. He is Phil Ball, Senior Account Executive at the Paramus office of Merrill Lynch, Pierce, Fenner & Smith. Phil has been handling investments for both large and small accounts for many years. He's taught adult school classes at the Northern Valley Regional High School for 8 years. And he's active in his hometown of Englewood, where he has chaired the advisory committee to the mayor and common council and was head of the citywide PTA. Okay, Phil, tonight we want to explore a world of investments, or another way of finding out how people accumulate capital. How do they acquire their money for leisure, for work, for play, for education, etc. Now, this is a treacherous world. And I remember some treacherous markets, the crashes, 29, the stock market breaks that occurred in 55, the downgrades, Eisenhower's heart attack, the Cuban Missile Crisis, the Kennedy assassination, etc. Tell us about these and why.
Carmen, I think it's interesting that you remember all the negative markets, all the bad markets we've had in the past 15, 20, 25 years. And unfortunately, the things that you remember are what most of our customers remember, and I think that there's a good deal of anxiety and a good deal of concern about stock markets because people understandably have a concern they're going to lose money. And I think that really the fact that there is emotion and people tend to sell in panic makes people forget, makes investors forget that panic selling really can create opportunities. And if there's distressed selling, there can be bargains available in the stock market too.
You said bargains. Well, what do you mean by a bargain? They don't have sales, I don't believe.
No, not the way you would find a sale in a supermarket, or not the way you'd find an automobile dealer having a sale. But in our business, if people can learn what good value is, they can really do very well for themselves. Now, I think the problem is, how do you really get to learn what value is? I suspect that if you talk to your wife about shopping, and if you talk to your wife about the price of sirloin steak, if she sees sirloin steak at 20 or 25 cents below the normal price, she'll know instinctively that there's good value there.
Of course.
Now, how does she learn that? You know, where did that come from?
Well, it comes from being aware and dealing in it, and in the market, most lay people do not deal in it on a regular basis. Sure, you're aware of, give me AT&T. You know what the price is every day, what it's been doing, what it's going to do. Well, let's take that back, but you're aware of the price. Drops to 50, you're going to say, hey, bargain. The housewife still is not going to be that aware. Is this one where you come in, an individual like yourself? Do I call you on the phone and say, hey, Phil, are there any bargains today?
Well, Carmen, to be candid with you, I think the tack you're taking now could be a little dangerous. First you say, could you call me on the phone? I've been a broker in Paramus for 15 years, and I have many clients that I know very well. As a matter of fact, one of the things I really like about my job, it's interesting, I'm now dealing with sons of customers and grandkids, which really is an awful lot of fun. And I guess you have the same thing in banking. Sure. But I'm a little hesitant about people being dependent on me, because hopefully I'm not going to work all my life. I have other things I want to do in life other than be a broker. Someday I'm going to be old enough where they're going to force me to sit in a rocking chair, or I'm going to have to go into retirement. So I think the important thing for the customer or the investor is to learn how to ask the questions that will enable them to recognize what is a bargain, or when is a stock overpriced. Okay? So I think the thing that we have to concentrate on now and help the viewers try to understand are, what are those questions? Where are they? What do they look for?
Let me go back a second. What kind of techniques can I use to avoid getting hurt during periods of crisis, some of them that I had mentioned earlier?
Okay, I think...
Is that a fair question?
Yeah, it's a very fair question. I think one of the first things that you have to do is to determine in your own mind whether you're buying stock in a company that is going to be here for a long period of time. Now that precedes the question of the price of the stock. And the classic example in our industry really is the horse and buggy manufacturer. You know, in the late 1800s in the United States, there were many, many men who made not horses, they didn't make horses. God did that. Well, horses made horses. But men made buggies, right? And people never dreamed that buggy manufacturers would go out of business. Well, people never could anticipate the automobile business in the United States. I think the first question you have to ask yourself is, can the company and can the industry survive on an ongoing basis?
Okay, now let me throw you a curve. Gee, I think there was a company named Penn Central who
Oh boy.
would have bet my life on 10 years ago.
Yeah, you're quite right. You're quite right. That's a curve. Yeah. As a matter of fact, it happens. Yeah, it's interesting. When Penn Central went under, there were many, many large institutions, major universities, and a couple states, by the way, had their money invested in Penn Central, and tremendous amounts of money of very, very sophisticated investors was lost. And the adage at that time was that Penn Central could never go bankrupt. You know, the government wouldn't let it happen. That is a tough one. I think, Carmen, that we have a different kind of answer to that. I'm not asking an investor, and I'm not asking any professional broker to say that he knows for certainty what's going to happen in the world. None of us know. You know, let's be candid about that. I think that you're raising another point. We can avoid the Penn Centrals. Let's assume that someone wants to invest money in common stock, and let's assume, for argument's sake, they have $1,000 to invest, okay? They would be better off investing not in one stock, which could be a Penn Central, but investing in 2, 3, or 4 stocks and getting what diversification, okay? Right, you're hedging your bet a little. Now, actually, and I oversimplified that example, but if you want the rule of thumb, when we're dealing with people and we bring money in, we're in effect helping them build a portfolio. A professional ordinarily would never allow more than 10% of the assets to go into any one stock.
Right.
So if there's a wipeout, such as in the case of Penn Central, you limit the wipeout to 10%. This is one way of protecting against that. By the way, I like that question very much. I think it's an extremely good question because one of the industries that's giving people a lot of concern now, the airlines industries. Sure. If you look at the problems that they have, and here you're involved not only in the problems of trying to outguess industry industry trends, you know, like with the airlines now, one of the carriers will cut the price of going to Los Angeles in half. Right. That could play havoc with profits. I hope it happens from the consumer's point of view. But one of the problems that you have with something like the airlines, and it was true in the
let me interrupt.
Railroads, was government regulation. Go ahead.
Okay.
Yeah.
Airlines, I'm a banker, I look at a financial statement,
right, and
hopefully I can read it and make some sense of it. How does the consumer, they're really not aware that you know, the airlines might be, and I'm not giving an indication that they're running into any problems, but there are certainly some weak spots there.
Oh, there are many weak spots, Carmen. There are significant weak spots in the airlines.
Yeah, the consumer goes out to the local airport, right, he goes down to Newark and sees plane after plane taking off, and say, wow, they must be making a fortune.
Yeah, right.
Okay, how does one spot this, though, on the outside?
Well, I think you are being, there are two answers to your question. First, we have some investors who are extraordinarily sophisticated, and many of these investors really could be brokers on their own because they read the good material, and they're really up on their investments. I guess there are investors who are into investments such as golfers who are into golf almost on a professional basis. There are other investors who really don't have the time or the inclination to do that, and I think those people really have to rely on their broker. And I'm not opposed to reliance on a broker, but one of the concerns I have about dependency is that people start leaning on you and they become totally dependent, and it's somewhat like using a cane or a crutch when you really don't need it, and you stop using the limb. You know, you almost stop walking and you go into a wheelchair.
Well, you know, now that you're in there, just how much reliance should I give to a broker? I call Phil Ball up and say, is your word that I want you? Is that it? You say,
okay,
I'm going to buy you 20 shares of X.
Okay.
Should I do anything further, or just go ahead, do
Carmen, many of your questions are being are really being answered not so much by Phil Ball or by Merrill Lynch, but by the technology.
Right. Okay.
Now, for example, the computer is just turning our business upside down. At Merrill Lynch, and we're not alone in this, many of the brokerage firms are doing the same thing, but at Merrill Lynch we have more resources. We're twice as large as the second closest competitor in the industry. At Merrill Lynch now we have about 1,400 stocks that are on a computer. I push a button, I can get an opinion immediately. That opinion is updated every 10 days. And within seconds you have an opinion as to whether you should buy, hold, or sell a stock. Now, that access to information offers great opportunities for investors, but I think what it really points up is the investor has to learn what the resources are, what is available, and how to get to them.
Is this data also available to the average investor? And where?
It's available to every investor. It's available without charge. There are no fees for it. An investor just has to come in and ask for it. Nothing else, and he can get it immediately. He doesn't even have to be a customer, by the way. Hopefully he will be a customer, but he doesn't have to be.
Okay, now, how about taking an example of a history of a company? Can we do that and bring me through step one through whatever?
All right. I started before in response to one of your questions, and I said, in my own mind, it's important that you determine whether the company's going to stay in business.
Okay.
I think there are a couple other questions you have to ask. I think you have to ask, will the company stay in business in the sense, will its product be antiquated by technology? So the buggy manufacturer was put out of business, not because he wasn't a good businessman, he was put out of business by the technology. By the way, some of the buggy manufacturers stayed in business. Studebaker, the Studebaker car came out of the buggy business.
Was he? I didn't know that.
However, then Studebaker ultimately got knocked out by Ford and General Motors anyway. Does the company have the resources to survive a bad economic environment? Now, you know, in your own case,
that's
in banking, you know, we had some real tremors there a couple of years ago, and well, we had Franklin Bank.
That's right.
They were hardly a little bank.
Hardly. Security out in the island.
Right. The Security National in Long Island. That's correct. But you always have a feeling, if you live in Bergen County, with a United Jersey Bank or the major banks out here, they can stand the storms, the economic storms. That's the second question I think you have to learn to ask. I think the third question you have to learn to ask is a company adding to its wealth? Is it acquiring more and more resources rather than just growing by building more and more debt?
Okay, I think I know the answer. Do they out there? What do you mean by resources?
Well, I think in simplifying it, if you learn what if an investor learns what a balance sheet is, and an investor learns what an income statement is, when you look at the bottom line after they paid all the bills and they paid some dividends and they paid bonuses and salaries to officers, have they acquired more working capital? Do they have more cash in the bank? That's building debt. And then finally, are they good to the stockholders in terms of dividends and dividend increases? Right. And in my view, and I think one of the things, Carmen, we might look at is the chart that I brought along today on a stock called American Telephone.
Let's take a look at it.
Okay. Now, the significant thing about the chart, and if you look back at the chart, you'll notice that we start about 1968, and there's a slope. There's an upward slope. Each bar represents the dividends paid. Now, initially going back about 1968, the telephone company was paying dividends in the area of about $2.50. Now, from 1968, 1970, 1972, 74, right up to the present, their dividends continually trended up. And the interesting thing is, while the dividends were trending up, in many cases the price was going down.
Right.
So this really, and you know, as we walked in the studio at the beginning, it's
bargain.
Right, exactly. And do you remember the man said, "Gee, I should not fool around some of the stocks I fooled around. I should have bought telephone." Well, I think if he's typical of the average consumer, here the price of the stock was going down, and the company was paying out more and more to the consumer. They were trying to tell you something. They were trying to say that there was good inherent value there. And the the interesting thing is that most people miss this. Now, in many cases, I found it difficult to get people to buy telephone because there was a lot of anxiety. One of the reasons for the anxiety was well-founded. The government did have an ongoing investigation of the telephone company, and people felt that ultimately some type of government control or additional government control might come in. But basically, people were just missing signals. The fact that the telephone company years ago had been growing very, very rapidly, and then the growth trailed off a little, but now it was coming into a new phase of expansion.
Okay.
And that's really what happened. And it is a good example of a bargain, Carmen.
As a banker, my conservative nature, I think I'm interested in earning money without a lot of risk. Now, how about bonds? We hear people talking about them. Could you explain briefly what kind of bonds, what are they, how are they purchased, etc.?
I want to address myself to one aspect of the bond market. I think that you're right. There is a popular impression that there is comparatively little risk in bonds, and I think that's a valid impression. But you have to be concerned about one other thing with bonds. Whenever you buy a bond, you're really making a judgment about inflation in the United States.
Okay.
Now, and for the moment, I'm going to throw the ball back into your court. If my folks, who really didn't have very much money during the Depression, as a matter of fact, my dad went bankrupt during the Depression, but if my folks put money in your bank in 1940 and took the money out in 1950 or 1960, they really lost money because the money...
Oh, your inflationary dollar.
Yeah, the purchasing power.
Sure,
you know, what my mother could pay for a loaf of bread in 1940, she probably had to pay 2 or 3 times as much for the same loaf of bread 10 years later. Now, that is one of the concerns about the bond market. So the first thing I would caution you about is if you're going to buy bonds, you really have to be careful if you're going to buy a 20 or a 30-year bond that you don't get hurt where that bond could depreciate on you significantly. We do have ways of measuring bonds. Bonds are rated by rating services. There are 3 services, 3 independent services, Moody's, Fitch, and Standard & Poor, that put alphabetical ratings on bonds, which enables the investor to make some judgment in terms of what they're getting for the money. Now, in terms of the ratings, and it's very simple, we have AAA rated bonds, we have AA rated bonds, we have A rated bonds, and then finally, we have bonds that are BBB. Now, all the bonds in any of the A categories are considered investment-grade securities. Yeah, right. As a matter of fact, most of them your bank would buy for their own portfolio. The BBB rated bonds are really considered a businessman's risk bond. Now, by that, there's a popular kind of conception that the average businessman has enough money coming in where he can buy a bond with a lower rating, because even if he makes a mistake, he's got more money coming in downstream to compensate for his error.
Okay.
Now, just to give you an illustration of that, bonds like Sears Roebuck, Montgomery Ward, Telephone, Public Service, Ford Motor Company, General Electric are all in the A, AA, or AAA category. A bond like, and by the way, those bonds pay anywhere from 8 to 8.5%. The A-rated bonds right now. A BBB rated bond at this point in time, an example of that would be one of the airline bonds, and Pan Am is paying close to 11% right now.
More risk involved.
Absolutely, absolutely. You know, why do you get 11% in one bond and only 8% in another bond?
Right. No one gives away anything for nothing today.
Usually not.
Or ever. Government bonds.
Well, government bonds are really fascinating, and they're really a synonym for cash.
Sure they are.
If you buy a government bond, and I assume in your bank, if people bring you a government bond, you would lend a person 90 cents on a dollar on a government bond, wouldn't you?
Exactly, sure.
Okay. Government bonds are really one of the areas where investors can help themselves make significantly more money. And let me give you an illustration of that. And I really don't want to be in a position of downgrading the government, but the government in a way plays games, because there are many, many people right here in Bergen County who hold the old war bonds that are paying, oh, I don't know, 4.5%, 4.75%. They could take that very same bond cash it
overnight,
and put it into a government bond
yeah,
paying 7 or 8%.
Exactly.
So when you talk about government bonds, and by the way,
But they do have an advantage of a deferred
that's correct, yeah, on taxes.
income on taxes. For whatever that might be worth. Of course, you've got municipals, and of course that's another subject all in itself, and I think we maybe just breeze right over that because I don't know if we have enough time.
Well, I think, Carmen, you talk about deferred advantages of government bonds. My own feeling is once people learn what interest rates mean, what compound interest rates mean, they really become intelligent investors very quickly. And there's an old formula, I guess mathematics teachers developed a long time ago, but if you take the number, the 2 digits, 72, and divide that by the rate of interest, that'll tell you how fast your money will double on a compound basis.
Okay.
So if you take 72 and divide it by 10,
give me that again.
Take 72, divided by your interest rate. Let's assume you're earning 10%, okay?
Right.
Money invested at 10% divided into 72 will double in 7.2 years. Money divided into 7, yeah, okay? All right, so if you're earning 4% on a government bond and you can go to a 7%, you can, forget the tax angle, you can really significantly make your money grow. And this is one of the things that investors should be doing. Investors should continually be looking at where they are and where they can make a shift without taking more risk in order to get a greater return on their money. And I would not pass by municipal bonds too quickly because that represents a very fertile area, and people are becoming increasingly
more and more aware of it.
Sure. There's another element there that is becoming very, very significant, and that's the brokerage industry has developed a product which is comparably new called a bond fund. And in effect now, a professional buys $30, $40, $50 million worth of bonds, puts them all together, turns them over to a bank like yours. You become the paying agent. The bank collects the interest and pays the income out monthly. And these are both taxable and tax-free. I think a product like that is probably maybe 4 to 5 years old. We have sold billions and billions and billions of these bond funds, both tax-free bonds and taxable bonds. And
okay, Phil, we're starting to run down.
Okay.
Can you give us maybe 5 or 6 key highlights that we've discussed during the past half hour? Maybe
Rules of the road.
Rules of the road. Great.
I think so. I think that first, if people own securities now, they have to take a cold, hard look to see whether they're holding on to some securities which really ultimately will have very, very little value. And people tend to do that. People tend to buy a security, become emotionally involved with it, think that ultimately they bought a stock at $10, it's now selling at $2, ultimately it's going to come back to 10, and that can be delusion. It may never come back.
Right.
So rule number 1 is to take a real good look at what you have and determine in your own mind whether it's ever going to come back. Does it have the potential to really recover? I think rule number 2 is not to follow the crowd. Probably the most astute investor we've ever had in the United States was Bernard Baruch. He was a man in a field all his own. He really was a giant. And he always told the story that you started to go wrong when you followed the crowd, the popular delusions of the crowd.
Or the hot item.
Right. And I think you really have to learn to make money. You have to learn how to buy stocks that are out of favor rather than stocks that are in favor. And I can illustrate that, by the way, with United Jersey Bank. About a year ago, your stock was yielding in excess of 10%.
10%, that's right.
And the stock was around $9 a share, and that stock was very, very attractive. By the way, when you look at the stocks and they're out of favor, people really don't want to look at them.
Right.
Don't want to stay with them.
Okay, well, maybe one last question. It's been told to me you don't buy stocks to hold on to. Is that true? Would you agree with that? I know it's maybe a broad statement. Yeah, generally, would you agree that you should be buying, selling, trading?
No, I don't think you
don't put them in a safe deposit box and leave them there.
Look, Carmen, I'm concerned that people don't churn themselves and generate commissions for the sake of commissions.
Right.
Okay. I think people have to continually look at their property and make assessments of where they are with their property and their life and whether changes are necessary. One indication of that would be to say, I own item A, take a cold, hard look at it and say, gee, it's great, I'm going to keep it.
Okay.
And that, in effect, is an evaluation, You've made a conscious decision that what you have is good. But this thing of putting something in the vault and saying, well, Aunt Jenny owned it, and I'll never touch it
Yeah,
because it's
right,
for sentimental
right.
value.
You see that.
That's just absurd. That
Okay.
really is absurd.
Okay. All right, Phil, I think we've come to the end of a very interesting half hour.
It went very fast. I wish we had more time. I
Well,
enjoyed it.
it's a subject that you could go on
Hours.
really for hours.
Hours.
We've hardly scratched the surface. Again, thank you very much. Maybe we'll do it again.
Gee, I would like that, Carmen.
Okay,
Thanks
great.
very much.
Right.
Good.